Good morning, everybody. Welcome to this morning's webinar on share schemes for private companies. I'll make it around about 11:30, so we shall kick off. So just briefly, my name is Sarah Anderson. I'm a director at the RM2 Partnership. I'm also a share scheme solicitor. I've been working in the field of share schemes, focusing mainly on private companies for around about 25 years. So I'll be leading the webinar today. There will be opportunity to ask questions online if you want to do that. You can also get hold of the webinar when we put it on YouTube. And if you've got any questions that I can't answer this morning or you think of afterwards, please just drop me a line. There's my contact details there, sarah.anderson@rm2.co.uk, or just give me a ring. Always nice to hear from people. Love to speak to people about share schemes at any time of the day or night. So what I'm going to talk about today, just a few brief topics. It's not going to be a particularly technical presentation, but I would like to talk about why you would introduce a share scheme for your employees in the first place, apart from the fact that it's Employee Ownership Day this Friday, so everybody should be doing it. I'll talk about a few design considerations, run through some of the key schemes that are available, and just cover off a few of the common questions we get about share schemes when clients are implementing them. So just to talk about why would you introduce a share plan for your employees in the first place? Well, in a way, I suppose you're kind of looking at two reasons, really, two groups of reasons, what you might call macro employee ownership effects and micro drivers. So the macro employee ownership effects are those that various studies and reports have ascertained are delivery outcomes of employee share ownership in its various forms, which include positive impacts on productivity, stronger economic performance for companies. I think particularly companies with a degree of employee share ownership operate more strongly than non-employee owned companies, particularly in recessions and downturns. So that's obviously quite interesting in today's marketplace. Having a share in a company will often help employees feel more empowered. They're more likely to make suggestions about innovation. They are often the people who understand really how the company runs right at the sharp end. So often the best people to listen to. Really good on employee retention and generally increased employee engagement. There are multiple studies looking at all these macro effects. One of the more recent ones is the Ownership Effect Inquiry from June 2017. Really worth having a look at that on Google if you can find it. It's got some really interesting reports on how companies with employee ownership have really seen a positive impact on their bottom line. But as well as those macro effects, there are micro drivers as well, which obviously are relevant to your company in particular. You might be interested in recruiting a new key staff member. You might be wanting to retain staff in the long term to achieve a particular corporate outcome. Often employees look at rewarding loyalty for long-term employees, or they might be looking at rewarding particular performance, whether that's performance of an individual or performance of a team or performance of the company as a whole. You can very much choose what you're looking to reward when you put your share scheme in place. Can really help focus on targets, not just targets as in I have to sell so many widgets this year, but big commercial corporate targets like an exit, sale of the business, a flotation. A key driver for lots of share schemes is the tax efficiency. It can often be much more tax efficient than a cash bonus scheme, for example. And it can also practically help you in terms of your succession planning ideas or exit solutions, whether that's a matter of transferring ownership to employees over a fairly long period of time, or doing it as a one-off transaction in a sale to an employee ownership trust. So plenty of good reasons why people introduce share plans, not just the I'd like to be like John Lewis rose-tinted spectacles look, but for some really strong practical commercial reasons behind a share plan for employees. So whenever you're putting a scheme in place, I mean, you are going to be giving away shares in your company, you need to think about the design of that scheme reasonably carefully. My first question is always, what do you and other shareholders really want to achieve by this? Are you looking for an exit or a flotation, or to sell the company? You're looking to retire? What's the next step in your company's life cycle, and how is the share scheme going to help you do that? Are you looking for potential investments, or are there any significant corporate changes anticipated in the future that you might need to take into account? Crucially, in terms of the share scheme, and this will help you choose the type of scheme that is best for you, do you want to involve all of your employees, which is the sort of John Lewis end of the market, or are you just looking to target just a few key managers, maybe even just one very key person you need to get in, and the promise of equity in your company is going to be the thing that gets them through the door? In terms of the individuals involved in the share scheme, are you looking at particular performance targets or exercise provisions? Are you, for example, just saying, I want to sell my company and I want my employees to share in the proceeds for myself? Simple exit only option plan might work for that. Or are you looking for particular performance targets tied to teamwork or performance of the company as a whole? In a way, that's the kind of looking forward or back point. Are you looking to the future and your options are going to be triggered by a future event? Or are you wanting to reward employees who've been around with you for a while and have delivered really strongly for you in the past, and you wanted to say thank you for that? And I just mentioned options, but that's a key question. Do you want to be using shares, or do you want to be using options? An option is not the same as a share. It's just a promise that you can buy a share in the future at a price that's fixed today. If you're using shares, at that point you need to think about, do your shares carry voting rights? Do they carry rights to dividends? If you're using an option, that's not something you need to worry about until the options are exercised and the shares are bought. That's quite a crucial difference to remember. You might be looking at time scale. I mean, again, if you're looking at an exit, are you looking at 3 years, 5 years, 10 years? Or do you want employees to become shareholders before an exit? Is that a bit, you want them to deliver a promise to them a little bit sooner than when the company's sold? Big question we often get asked is, how many shares should you use in your plan? Remember, private companies can do exactly what they want in terms of giving their shares away, but there are various rules of thumb that you can use as a starting point. And the big question there is effectively, how much dilution are you and the other shareholders happy to wear in return for the potential growth that your newly engaged and motivated employees will deliver? I've noted internal share market here because, of course, a private company share, although it has value, certainly according to the Inland Revenue, is only really worth something when it's sold and when somebody buys it. And obviously there's not usually a marketplace in a private company for the shares, but you can create your own. You can create an internal share market if you wish to do that by setting up an employee benefit trust or a share incentive plan, which can also be used as a share market. So if you want your shares to have a little bit of liquidity, which can deliver more value to employees over the years, that's certainly possible, even in a private company. Important question is what to do with leavers. Obviously, we all start off thinking that an employee is going to stick with us forever. That doesn't really usually work out like that. You do need to make sure if you've given an employee a share or an option and then they depart employment, you know exactly what's going to happen with their shares and their options at that point. And then finally, how often are you going to make your share plan award? Just annually? It might just be a one-off. You might think, I've got a collection of really loyal employees. I want them to share in 5% of the company when we sell it. But that's all I'm giving away. That might just be a one-off offer, and that'll be absolutely fine. It's entirely up to you to decide what to do. So those are the key design questions that people should always think of before they really decide what kind of plan they're going to put in place. So let's just talk about those key schemes. These are the ones we commonly advise on. And I've divided them here into schemes that involve share options, not a share, just an option. Schemes that involve the purchase of shares, and then finally schemes that effectively involve the gift of shares. And I have divided those down further into schemes that are discretionary, meaning you can offer them to just 1 or 2 people or a small group of key players, and schemes that must be offered to all employees in order to benefit from the tax advantages that they offer. So in the left-hand corner of the ring, we have the Enterprise Management Incentive and the Company Share Option Plan, which are both tax-advantaged discretionary option schemes. And we also have unapproved share options. That's a bit of an old-fashioned name. They're really not, they're called non-tax advantaged share options these days, and the clue is in that name, in that they don't carry any tax advantages. But there is an easy alternative if you're not so bothered about the tax treatment. And then phantom share options, which actually aren't really even share options at all. They're just a cash bonus plan, but I'll put it there for the sake of completeness. And then in the middle column, we've got share plans involving the purchase of shares, which can be used for a few people, which is the deferred share purchase scheme, and growth shares. All employee plans include the share incentive plan, which I've put into the purchase and gift column, because you can purchase shares under a share incentive plan, and you can also give shares under a share incentive plan. It's a cracking scheme. It's insanely tax efficient. It's very flexible. I absolutely love it, and I will talk to you about that a little bit later on in this presentation. And last of all, the All Employee Ownership Trust, which is the scheme you will use if you want to retire and sell your company to your employees and pay no capital gains tax. And then another cracking scheme, one of the more recent ones in legislation. So I'm going to run through each of these schemes, just a quick overview so you can see how they work and what the key advantages are of them. So I'm going to kick off with EMI and CSOP, Enterprise Management Incentives, Company Share Option Plan. Both discretionary schemes, you can give them to 1 person and give them to all of your employees if you want to, but you don't have to. And you can give them as many or as few options as you want to. It's entirely discretionary within certain limits, obviously. Just as a reminder, I will labour this point. These are share options. They're not shares. They are promised to buy a share in the future. And nobody will get a vote on their shares or a vote on their options. Nobody will get a dividend on their options. That only happens once they've exercised the option and got the share. Both EMI and CSOP must be run in independent companies that aren't under the control of another company. And EMI has some limits on the size of company that can use it and the type of trade. I'll run through those in a minute. They're both very long established, very popular plans. EMI is the younger one. It's been around since 2000. CSOP, I think, has been around since about 1994 in various guises. So very reliable old plans, these. You can rely on these to do what they will say on the tin. And they're both very flexible and very tax efficient, but EMI is more flexible and more tax efficient, which is why if you can use EMI, you would always use that rather than CSOP. So a quick summary of the tax treatment. In both cases, on the grant of options, there is no income tax to pay and no national insurance contributions to pay. On the exercise of options, the same applies. There is no income tax charge when their options are exercised, provided the options aren't granted with an exercise price of less than the market value at the outset. Under EMI, you can't do that with CSOP anyway. So you're going to let people exercise options, pay the exercise price, and there won't be any other tax charge, even if the share value's gone up. When the shares are sold, capital gains tax applies, obviously much more beneficial than income tax. So that's a nice little bonus for people when the shares are sold. If you're using an EMI, you will get business assets disposal relief on your EMI shares. Used to be known as entrepreneurs relief, and that gives you an effective 10% tax rate on the sale of your shares. You don't get that automatically with CSOP. It will depend on the usual rules for business assets disposal relief, but you're still going to get an effective 10 or 20% tax rate for CGT, depending on the participant's tax status. So certainly if you look at that in terms of the alternative being a cash payment, significantly more tax efficient using an option scheme if you were going to deliver people rewards on, for example, the sale of a company. Just a quick summary of the rules relating to these two option plans. And this is where you can see EMI is a lot more flexible and more generous than the company share option plan. You can exercise an EMI option tax efficiently pretty much any time from the date it's granted. There's no time limit. With CSOP, you have to wait for 3 years before you can exercise that option tax efficiently. Both are discretionary, as I've mentioned. You can set the exercise price for EMI at whatever you want, which can be helpful, although there will be a tax charge on the discount when the options are exercised if you choose to do that. A company share option plan option must be granted with an exercise price that is equal to the market value of the share at the date of the option grant. And you can see at the bottom that fortunately HMRC are still happy to agree the market value of shares over which EMI and CSOP options are granted. So that can be very helpful and is actually quite essential if you're going to make sure that you don't break the rule relating to the market value exercise for CSOP, and also to make sure that you can keep an eye on the limits applicable to the options. So each EMI participant can receive options over shares with a value of £250,000 at the date of grant. There is a limit of £3 million per company because EMI is really aimed at smaller companies. There's not going to be millions of people getting £250,000 worth of share options. HMRC wouldn't wear that, so they've got a company limit on that. Excuse me. CSOP doesn't have a company limit, but there is a much lower 30k limit for each participant, which again has to last you for 3 years. So you could grant options today with a £30,000 limit, and after 3 years they could exercise, and then you could grant some more CSOP options. So you've effectively got 90k's worth of options over a 10-year period. EMI has extra flexibility in that you can use any kind of class of shares with EMI, including non-voting shares, including growth shares. It's much more difficult to do that with CSOP because there are certain rules relating to the different shares with different share classes in their articles. You can do it. It can be very difficult and complex and costly to make sure that you don't break the CSOP rules if you've got multiple share classes. But with each, I'm just going to shut the window. Somebody's emptying bottles. Sorry. Each scheme you can have tailored performance conditions, you can have tailored leaver provisions, specific rules for CSOP. But if somebody leaves and they've got an EMI or a CSOP option, you can usually make sure it lapses. So that's a summary of the schemes. A couple of extra points for EMI. Everybody must be an employee to get these schemes, by the way. This goes without saying, these are employee share schemes. An EMI person must be working full time or 75% of their working time. Mustn't have a material interest of 30% or more in the company themselves. The company has to be independent and with fewer than 250 full-time employees, fewer than £30 million worth of gross assets, and they have to carry out certain trading activities. The most obvious ones that are excluded are financial services. And then there are a couple of other little things for EMI which can cause a trip if you're not aware of them. You must have only qualifying subsidiaries. Those are subsidiary companies where the EMI company owns more than 50% of the share capital. A joint venture can often create an issue for an EMI company. So if you have a joint venture, do take care to look at it before you crack on with your EMI. And if you're an investment company, even if you're not an investment company, but you happen to have something which HMRC might consider to be an investment, you need to be a little bit careful there as well. There's also an exemption for companies that get money from leasing or licensing or royalties. You can get around that, but you would usually want to make sure that you clear it with HMRC first. So just a few little warning points about EMI before you crack on with it. I have spoken for far too long about EMI and CSOP options, so I will rattle through some of the other plans as well. So this is the growth share plan. We are now looking at a discretionary plan that uses shares which are bought. Now, this is not a tax advantage scheme in the way that the EMI and CSOP are, because those schemes have HMRC blessing. This is just an arrangement that is tax efficient. It involves a direct share subscription. So once you've got your share, any growth in value is taxed to capital gains. That's where the tax efficiency comes in. The reason it's called a growth share plan is because it effectively protects the current value in the company for the existing shareholders, and the people who have the growth shares will only benefit from the growth in the value of the shares from the date of that award. So effectively, you need to create a new share class, which could be non-voting, non-dividend paying. You put a hurdle on the shares, which is based on an uplift to the company's current value. So for example, assuming your company is worth £10 million today, your growth shares would have a hurdle based on them of, say, £11 million. So when the company is sold, it's only the excess over £1 million that those growth shareholders would share from. As a consequence of that, the argument is that because the company is nowhere near worth £11 million yet, a share that only pays out when the company is sold for £11 million can't be worth anything, or if it is worth something, it's not worth very much. And that should result in the people only paying nominal value or a very low value for their growth shares. The valuation process is very important in the growth share plan, and it cannot be agreed with HMRC. So you need to be able to rely on the people who are providing a valuation for your shares, whether it's your accountant or another advisor, or the directors need to be quite comfortable that they are happy with what the company value is. However, if you grant an EMI option for a growth share, you can agree the valuation with HMRC, which can give you some extra comfort, and you will also make sure that because you are using an EMI wrapper, your growth shareholders will not only benefit from capital gains tax treatment, but they should also get business asset disposal relief. Just a note at the bottom, this is share ownership, so do ensure that the shares can be bought back from the leavers. You would need to look at your articles of association and probably put something in your subscription agreements as well to make sure you're not left with ex-employees with potentially very valuable growth shares. So that's your growth share plan, discretionary share plan, tax efficient, and hopefully just delivering capital gains tax treatment. A bit more complicated than EMI and CSOP and shares, so a little bit more care needs to be taken rather than options. Another alternative to growth share plan is a deferred share purchase plan. Again, discretionary, give it to whoever you want. Again, tax efficient, but not HMRC approved. Again, direct share subscription, so the growth in value is taxed to capital gains. You can use a new share class, but if you're just going to be using your existing shares, say your ordinary shares, they've probably got a value. Let's talk about that £10 million company we'd put growth shares in for. Don't put growth shares in, just use ordinary shares. Company's got a value of £10 million. How are you going to get your employees to pay for their shares or avoid an income tax charge at the outset? Well, the basic point is you say you're going to buy these shares, you only pay the nominal value, we'll leave the rest outstanding as a loan, which you can pay off even potentially when the company is sold and the employee has the wherewithal to pay that. The risk is that that loan must be repaid even if the value of the shares drops. So that is a risk, and we don't usually recommend this unless you're talking to fairly senior employees or people who've got enough money to take that financial risk. You could pay the loan out of the dividends, actually, if they have dividend paying shares. Some of our clients do that. They get a dividend paid each year and use that to drop down the loan. Again, you can't agree the valuation with HMRC with the deferred share purchase plan, I'm afraid. And again, it's share ownership, so you need to make sure that the shares can be bought back from leavers if they depart. Now, this is my favourite plan because I do love a share plan that lets all employees get a little piece of the action. And this plan does exactly that. It has to be offered to all employees and it has to be offered reasonably fairly. but it is a plan with HMRC's blessing, and it has the potential of zero tax treatment. So I'm just going to say that again: no income tax, no national insurance contributions, and no capital gains tax. It actually doesn't get better than that. Obviously, you have to follow some rules and jumps through hoops to get that zero tax treatment, but there it is, big fat zero. It's effectively indirect share ownership because the shares are held in a trust on behalf of the employees. They don't own the shares directly, but they can still receive dividends on the shares and they can still vote them if you wanted them to do that. It's a bit of a pain doing that, if I'm honest. You probably want to avoid it, but they can do. So it's kind of proper share ownership. It's just as easy to keep it in one pot rather than going to and fro between individual employees. And the nice thing about the share incentive plan is it's very flexible. So you can give free shares to your employees without any tax charges arising. It is a key thing. Obviously, if you give an employee a free share and it's worth £10, HMRC will basically see that as £10 worth of cash. This is the only scheme where you can give employees free shares that have value, where there is no income tax or national insurance contributions arising. You could also let your employees buy shares. These are called partnership shares, and they can be purchased out of pre-tax salary. And for every partnership share that your employee buys, you can get up to 2 further free shares. So you can get £9,000 worth of shares each year into your employees' hands, for which they will have paid less than £1,800 because they'll have paid for it out of pre-tax salary. There are no company limits. You can use a different share class if you want to. Again, this is share ownership, but in a way it's easier than the other share plans because you've got a trust there. So once a person leaves the company, they sell their shares back to the SIPP, and the SIPP just reuses those shares for future awards to all employees. We've got companies who've got SIPPs that have been running for 6, 7, 8 years longer. And it works very nicely. Constant recycling, constant selling of leavers shares. Even people who aren't leaving will sometimes sell their shares back to the SIPP to get some cash out. It's your internal marketplace sat there working very nicely for all the employees in the business. I suppose a word of warning, I haven't gone about the zero tax. It's a long-term plan, the share incentive plan. To maximise that tax treatment, the shares have to be held in the trust for 5 years. You get some tax advantages after 3, but the maximum tax advantages are delivered after 5 years. So it's a bit of a plan is for life, not just for Christmas type of share plan, the SIPP. Nonetheless, I love it. I think everybody should have one. And then last of all, the employee ownership trust, which is, it's not really a share plan as such, but it's an employee ownership arrangement. It's transaction based. A lovely new alternative to the traditional succession solution of selling sometimes to your competitors. Not always attractive. Winding up the business, definitely not attractive. Selling the business to your employees to create a long-term, sustainable, ongoing business under the next generation of managers. Sometimes described as the John Lewis solution. Effectively, the existing owners of the company, if they sell a controlling interest, so 50% plus of their shares into an employee ownership trust, they pay no capital gains tax on those proceeds. Zero. That's another zero. Now, the trust has to control the company on behalf of its employees. It must be the controller. Once you've sold your shares to the EOT, you don't run the company anymore. You can still be working in the company. You can still be a director of the company. But ultimately, you've got a shareholder, and that EOT is now your boss in terms of owning the company, making the big decisions. Of course, directors do the day-to-day running of a company anyway. But you do need to be aware that you are no longer the big shareholder if you sell to an EOT. And again, like the SIPP, it's indirect share ownership. It's even more indirect than a SIPP in that typically the shares just sit in the trust. Typically, they don't pay any dividends because it's not very tax efficient to do that, to be honest. Instead, there is an allowance for EOT controlled companies to pay up to £3,600 worth of cash bonus per employee per year, free of income tax, not free of national insurance contributions. Don't really know why. Maybe they just left it off the legislation. But anyway, it's just NICs, but still not income taxable. And when you've got your EOT holding a company, there's actually no reason why you can't deliver direct share ownership by way of other employee share schemes if you want to do that. So you can have an EOT owning, say, 75% of the shares, and an EMI or even a SIP utilising the remaining 25%. That can work very nicely. I have spoken too long, so I'll rattle through some questions. When should options be exercised? Some questions of control, how much equity to use, and some thoughts about performance conditions. I mentioned earlier the point about having an option that's exercisable only if the business is sold, typically called exit-only options. Very easy. Here's your option. If I sell, you can exercise it and share the proceeds. If you leave, it lapses. No direct share ownership, no votes or dividends. No worries, somebody goes, don't keep your options. If you've got direct share ownership, you've got a slightly different issue in that you've got the possibility of votes, dividends, and that leaver point. You must make sure you can get the shares back from leavers, or at least if you want to get shares back from leavers, you must make sure of that. Otherwise, you will have ex-employees with shares in your company, and you may not want that to happen. Private business owners are always very worried about control, not unreasonably, it's their business. Going back to that exit-only option, not really any control concerns there. They're only options, they don't have votes, they don't have shares. The only thing you need to worry about is the dilution on a sale. Direct share ownership, you could have a control issue if you've got people with votes, but if you use a different class of shares without any votes, that's not a problem. Probably a bit pointless using shares that are non-voting and non-dividend paying shares. What's the value of that to an employee, really? But the most important thing is, like, if you're only giving away 5% of your company, you've still got control. It's really not a problem. Again, you only need to think about that ongoing dilution on a sale. And just while we're talking about dilution, percentages, people always say, how much should I give away? Percentages is a really good starting point, but you need to think about, what is it a percentage of? Everybody says, oh, I'll give away 2% to John and 3% to Philip, and a maximum of 10% to all of the employees. And that's a really, really, really good starting point. But here's why it doesn't work for dilution. And forgive me if you know this, but a lot of people don't. So just please bear with me while I just go through this. We have a company, Mugatu Limited. There are 1,000 shares in issue, and there are 4 shareholders, and they each have 25% of the issued share capital. And they grant Zane 100 options. Options are not shares. There are still 1,000 shares in issue, and each shareholder still has 25% of the issued share capital. Zane hasn't got any percentage of the issued share capital yet. He's only got options. Anyway, then he exercises options, and the company issues new shares, 100 new shares. So now we have 1,100 shares in issue, and each of the original shareholders now has only 23% of the issued share capital, and Zane has 9%. So the original shareholders have been diluted down. Still got the same number of shares, the percentage has changed. And so it goes on. We've now got 1,100 shares. Jane gets 50 options. Everybody else is the same at the moment, still just options. Zane's got 9% of the issued share capital. When Jane exercises her options, 50 new shares are issued. Now there are 1,150 shares in issue, and everybody gets diluted down a little bit. So Zane has been diluted down to about 8.5%. Everybody else has got about 22%. And Jane, who might have looked at her 50 shares and gone, oh, that's 5% of 0.5%, whatever, of 1,000 shares, actually has 4.3% of the issued share capital. So that is how dilution works. And I have one rule for dilution, which is do not promise employees a fixed percentage of the equity unless you're absolutely certain that you're not going to be giving any more options away or any more shares, and that none of your existing shareholders are going to leave, because that percentage can change depending on how many shares there are in issue. Vesting conditions. You can have options vesting over, for example, something really easy like 1/3 over a 3-year time period. That's really easy. You can have performance measures. And the same rule applies to performance measures in an option scheme as anything else. They must be smart, simple, measurable, achievable, realistic, targeted. Corporate targets, I think, are better because you can look at a line in your accounts and say, John, we did not achieve that line in the accounts, so your option has not vested. You can use individual targets. as long as they meet that SMART acronym. You do need to think about maybe what happens if there's an early sale. So if you've got a set of performance targets that lasts over 5 years, but you sell in year 3, do employees get to exercise all of the options because you got to that sale point? Or do they only get to exercise 3/5 of the options because they only met their performance targets? Something you need to decide at the beginning, because you put those performance targets into an option agreement, which is a contract, and it can be quite difficult to change them later. So you need to think, if you're going to be putting in complicated performance conditions, do think about them reasonably carefully before you commit them to an option agreement. Quick point on levers. Options, much easier than shares, as I keep saying. If you've got a bad lever, and a bad lever in my world is somebody goes to get a new job or just decides they're going to go and sit on their yacht for a year, all options lapse on cessation. Good levers, in my world, a good lever is somebody who's dead or has become critically injured in some way that they can't work anymore. You might want to treat good leavers a bit more kindly, because those are not happy reasons for leaving work and people don't have any control over them. So you might let them keep the options that are vested, or you might allow them to exercise their options and buy their shares back. With shares, you do need to buy the shares back from leavers in some way. You can usually amend your articles to make sure that if they're a bad leaver, gone off to sit on the yacht, they only get back what they paid to buy the shares in the first place. So they're not making any money out of it. Good leavers, you might want to pay them the market value, and you'll probably need to amend your articles to make sure that works. RM2 usually recommends that ex-employees are not permitted to keep options or shares. Plenty of companies do let ex-employees keep them, but smaller private companies, generally it's advisable not to do that. It just gets messy, and you don't want to be rewarding people who aren't working for you anymore, in my experience of private companies anyway. Few questions. We must answer these questions before you put share scheme in place. Why am I doing this? Do ask that to begin with. Ask who's going to join. Ask what kind of shares you're going to use, voting, non-voting. When are employees going to get shares? Maybe just when you sell. How much do employees have to pay for their shares? And that's down to you need to do a valuation exercise. How many shares should employees get? That's your dilution point. And what if employees leave? And once you've got those questions answered, you'll actually be a good way to deciding what kind of plan you want to put in place. 3 things to take away. I always say this, always look at why first. Always look at why first, because if you don't know why, there's just no point doing it. Keep it simple, because arguments arise and complicated is more expensive. And finally, I've talked about the tax treatments of a lot of these share schemes, but commerciality comes first. Never let the tax tail wag the commercial dog, as they say. So I have now finished my presentation, and I do not know if there are any questions. And it's a very funny little screen, this, which comes up with questions in little tiny boxes. Why aren't SIPs more popular than EMI? Is the setup cost much higher? Yes, I think it's large. Well, there are various reasons. They are more expensive than EMI. You have to have a trust. They run, you know, you need to keep the trust running for at least 5 years before the tax treatment happens. I think the 5-year period is a very good reason why people don't like SIPs. It's such a long way to wait. We keep lobbying to HMRC and the government, and they're just not changing. It's really frustrating. So yeah, the setup cost is higher, the admin costs can be higher, and you need to give it to everybody. And actually, that's just not for all companies. Not all companies want all of their employees to have shares. So it is a little bit of a cost issue. On the EOT, when you pay a 3,600 cash bonus, is that dividends from the shares? No, it is not dividends from the shares. It is a cash bonus from the employing company. Can we receive copies of the slides, please? Yes, you can. I will send them around afterwards. You mentioned some restrictions on the type of companies that can use EMI. Would an EMI scheme work for an SaaS company where revenue is generated from the licensing of software to clients? That's probably a bit of a tricky question just to answer on this presentation, but the very short answer is that usually if it's software that's been developed by the EMI company, you should be fine. If it's software which has been brought in from somewhere else, then it's not fine. But if you email me, I can send you a link to the relevant bit of the revenue manual. And sometimes it is sensible to get advanced clearance from the revenue to make sure you're not breaking the rules, which we could help you with, obviously, if you'd like us to do that. How do you contractually define a good leaver? It depends on the type of scheme that you are using. In the case of the company share option plan and the share incentive plan, good levers are defined in the legislation. EMI, there is no definition in the legislation. You would use your own definition. We usually recommend you kind of follow the rules of the other share plans just because it makes more sense, but it's up to you. You'd usually put something into the rules. I would tend to not overthink it, and I would tend to try and make it as heavily dependent on director discretion as you can get away with the proviso that discretion must be exercised reasonably and fairly, and not in a crazed willy-nilly way. So you just need to be a bit careful about discretion when you're using it. How does the trust work? Who runs it? What are the costs, and where does the money come from to buy back shares? That is such a large question that I'm afraid I can't answer it here. The cost will depend on the trustees run the trust, whoever they are. The cost will depend on what kind of trust it is. And money from buying, well, I'm sorry, I can't answer that question here. It's too complicated. I'd be very happy to have a conversation with that person. If they drop me an email, we can talk a little bit more about trust, but it's just too big a question for this webinar. By default, a lever is bad. So how by exception do you define good levers? Well, I think that question's already been answered. You can define what a good lever is and what a bad lever is. So none of the schemes work for subsidiary undertakings. No, they don't. You would have to use shares. That's not true. EMI and CSOP have to use shares in the top company, as does SIP. The HMRC recognised schemes don't operate really in subsidiary companies. You need to use the shares in the top company. The growth share plan and the deferred share purchase plan, and indeed the non-tax advantage share option plan, you can use shares in subsidiary undertakings. HMRC don't really like subsidiary undertakings for share schemes. That's why their approved plans don't work in them. If I sell over 50% of my company to an EAT, where does the cash come from? Effectively, the company, and the money is paid back over a period of time out of ongoing profits of the company in the future. There is a more detailed webinar on our website about EOT transactions and valuations. And again, I'd be happy to send you links and some more information if you drop me an email. EMI seems easy to implement. Are there any particular compliance traps with EMI that can crop up at the time of the sale? I think I see you has asked that question, and I think I will take that offline if that's all right. Because again, it's probably a bit too big a question for this webinar, to be honest with you. Would you recommend an EOT? Whoa, hello, I've missed something. With a family company with sons taking over, so father can take money tax-free. Are there any issues with the trust and non-paying dividends? This is, again, if you would like detailed questions about an EOT and how it would work in that particular situation, I would recommend that you call in and speak to one of our consultants about EOTs, and we can talk about it in a little bit more detail there, because that sounds like quite a specific question for a particular situation. Probably not appropriate. Do you assist with evaluation in the profit and loss charge for options category? No, I'm afraid we don't do that. I'm really sorry, I can't help you. That's kind of Black-Scholes methodology and options expensing, I think. We do valuations for company shares for share schemes, but not Black-Scholes methodologies. Thank you. Somebody says a very good session. Thank you. I'm glad you enjoyed it. Somebody else says thank you. Thank you. Could any of the schemes work for one single employee to take control of the company? Possibly. I think that might be a bit difficult. I think that's more. It'd be interesting to talk it through. The person who asked that question. Gosh, there were lots of questions. I'm sorry, I've rattled through them. There were some Oh, if there's an awful lot of clicking, is it possible to mute it? I'm sorry. I'm sorry if people had some sound issues there. I think only perhaps a couple of people did. So hopefully that was okay. I'm sorry I haven't been able to answer all of the questions in a huge amount of detail, but we are now at 12:15, which I think was probably my maximum running time. I am very happy to take those questions offline if you would like to arrange a call, or if you would like to drop me an email. And if I can't help you, one of my colleagues will be able to. So for the time being, I will just say thank you very much for listening. I hope you found it interesting, and I would be very happy to speak to any of you when you have the time or the inclination just to pick up the phone or drop me an email. For the time being, I hope you have a nice morning, and thank you again for listening.